Well, it was a tough session for the market after the Dow rallied for 8 consecutive sessions. Now, of course, there was never a sense of desperation, but it was pretty clear the market was grappling for leadership in the wake of better than expected news across the board. The market stumbled on a combination of higher Treasury yields and a stronger dollar. And yet the reaction, I got to tell you, it was subdued compared to the run-up to 3% on the 10-year. Considering initially, right, the run-up February 2nd, the 10-year soared almost 8 basis points, 2.85, sending the Dow off 666 points. The yield that day reached its highest level since January 2014. In fact, for the week, it was up 19 basis points. Then came the moment of truth, April 24th. It finally happened. Your 10-year Treasury yield hit 3%. The Dow Jones Industrial Average responded with a 424-point decline. Now, the new reality. Today, the 10-year yield rallied to its highest level, 3.095, the highest level since 2011. The Dow, it stumbled, but it finished off the lows of the session and down 193 points by the closing bell. So using the peak, if you look at the chart of the 10-year yield going back to 1985, I say it's finally broken that downtrend line. And it's conventional wisdom probably over the last couple of months would have said when this happened, the market would have collapsed completely. Now, to be sure, it's a problem. So is the dollar surging because that's not good for multinationals. The big losers in the session, utilities, real estate stocks, they lose their luster because higher dividend payers have to compete with bonds with higher yields and, of course, more stable. So the question now is what sectors or industries continue to look attractive in this new high bond yield environment. I love the action today in semiconductors, building materials, chemical names, and retail names. Here to discuss, Chris Versace, co-founder and chief investment officer, Tematica Research. Chris, thanks for joining us.
Oh, happy as always, Charles.
So what do you make of this move? Of course, earlier in the year, just the threat of 3% was sent to market, in a tailspin. Today wasn't so bad, and we broke through it pretty big.
Well, we've been getting a number of indicators pointing towards higher prices, inflation, if you will. And I think the market is starting to price in the fact that we will get 3 rate hikes. There's no question about that. Now we're starting to see the probability come up for 4. And I think that, so we're starting to see that really get baked into expectations.
Handicap for us and the difference for equity investors between 3 rate hikes or 4 rate hikes?
I think it's going to be 4.
Okay.
I absolutely do.
So does that mean you stay in the market?
I absolutely stay in the market, but you remember, Charles, I invest a little differently, right? We invest thematically. So we're looking for companies that have these pronounced tailwinds intersecting economics, demographics, psychographics. So for companies that are seeing these tailwinds continue to push on their business, they're going to generate immense operating profit growth. It'll be positive to their bottom line. They'll continue to go higher. Companies like Amazon, companies like Applied Materials, companies like Costco.
So you like the semiconductors today?
Yes.
Costco, what do you think? Costco is it's obviously if it's in your 401k, I don't think you ever want to touch it, at least for not for a long time. But near term, and considering the way the street reacted to Home Depot this morning, which in my mind had a pretty good report, volatility, could all of these names be sort of subject to the kind of volatility that will shake investors out of the market?
Well, a couple thoughts on that. I mean, if you looked at you mentioned retail sales earlier on the program, 4.7%. Costco's April same-store sales, 7.9%, and that's after, excluding gas, foreign exchange. They're going to open up more stores, more warehouses, and that's the key driver of their operating profit growth. So I just see that stock continuing to move higher, and I'll tell you what, if volatility comes along and knocks it down, I'll be backing up the truck.
The role of the Fed then and 4 rate hikes certainly would tamp down on the market a little bit here. But what about the consumer? Because these names that you're talking about ultimately are consumer driven.
Right.
A lot of anxiety about this consumer that seems, in my mind, to be reluctant to overdo it. I think it's a fact that people lived through the Great Recession. I don't think they're going to get over their skis like they did in the past. Doesn't mean they won't spend, though.
Well, I think they will spend. I think they'll spend more selectively. I think they'll spend more online. The way I look at it is we have a cash-strapped consumer investing theme. Look, April wages, real wages, not really higher. If you look at total consumer debt as a percentage of disposable income, it's at 26%. Great Recession, 22%. So, yeah, consumers are tapped, but they're going to continue to spend for certain necessities. That means places like Costco, places like Amazon.
Costco, Amazon, what's the third name again?
Applied Materials is the one I would go for.
Semiconductors, love it. Thanks a lot, Chris. Appreciate it.